Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Ian Barrass, manager of the Henderson Alternative Strategies Trust. Hello, Ian.
Hello there.
So I thought we could have a look at the trust in depth, a little different to what we do on this series usually when we go macro, and that's because it has a very interesting story.
Yes.
Looking at the 1 and 2 year figures, performance is strong,
yes,
but having a look at the 5 year figures, it starts to look quite negative. Why is there that disparity?
Well, we took this trust over 4 years ago, and that was a result really of some underperformance that occurred with the trust, especially during the course of 2012. And it resulted in the board deciding to put the investment management agreement for the trust out to tender. And we were one of 33 firms that pitched to actually get the mandate, and we were delighted to win the mandate. But then it did involve restructuring the portfolio that we inherited, which really, quite frankly, given that it was relatively illiquid, took time to do. But we managed to restructure 80 to 85% of it after a couple of years. So it did take a few years to actually get the portfolio in the state that we wanted it, to upgrade its portfolio quality, and really get it looking like we really wanted to look like. So the last couple of years, it's been very much a Henderson portfolio, as it were.
And you've touched on the strategy there by mentioning the illiquidity of the assets, and that's because this is an alternative strategy.
That's right.
Alternative is rather a catch-all term. It means all things to all people. What does it mean to you?
Well, this is a very broad-based portfolio that we run, and one of its beauties is that we have created a portfolio. The investments, individual investments, we think our shareholders are unlikely to hold very many of them themselves. So it genuinely differentiated, genuine diversifier, seeking to deliver global equity returns. But the specific things we do invest in on a global basis, we've really put into 5 investment categories. There's private equity, there are hedge funds, and there's property, all 3 well-known alternative asset classes. And then we have 2 other categories, one called specialist sector, which really means we can invest in any particular fund that focuses on a sector, often in an alternative or a specialist basis. So it might be renewable energy, or it might be a credit fund, for example. And the 5th category is what we call specialist geography. And those are funds that are run by managers who focus on particular geographies, either in terms of fixed income or equity investment. And that really is where we get a lot of our emerging market exposure from.
Alternatives have had quite a lot of press in recent years, partly because of this search for income, equities and bonds not delivering what they need to for investors' portfolios or indeed cash. And also the fact that equities and bonds have become increasingly correlated because of quantitative easing. However, alternatives are not suitable for everyone. So what role does this trust play in a portfolio? Because presumably there is greater risk associated with some of these asset classes than
You're
others.
right, Emma. There's no denying that. And we have a world equities benchmark, so clearly there is an equity target return that we have over a period of time that we're trying to better. And there is a reasonable degree of risk in this portfolio. There has to be, because of that return dynamic. So at one end of the spectrum, we can be looking at return requirements for individual investments over holding periods of anything up to 3 or 5 years of perhaps 18 to 20% per annum, with perhaps some of our private equity investments would fit that category. At the other end of the spectrum, we will go down to looking at returns for individual investments of perhaps 8% per annum over a holding period. And some of our hedge fund investments would fit into that category, for example. So we've got a very broad range of returns to choose from, but we must blend it down over the course of a period of time of 3, 5 years or more into a net return that is going to be better than global equity returns. So we have a target, an NAV total retarget annualized of 8% per annum. So we're trying to achieve here, because if we do that, then we should, over a period of time, depending on which period of time you measure global equity returns over, we should perform better than global equities. And this is all about providing an alternative to investors who want global equity-like returns, but want a diversified, differentiated way to actually achieve, a different way to achieve those returns. And that's what we're after here.
Ian, thank you very much. This is Emma Wall from Morningstar. Thank you for watching.